Gold prices hit a record high just above 1,900 back in September of 2011. After dropping down to the $1,500, $1,600 level, they've been pretty steady until now. Joining me from Chicago to discuss the recent volatility in the precious metal is Sean Lusk, a commodity broker and gold and precious metal analyst for Iron Bean. Sean, thanks so much for joining us. Let's get straight into it. Gold is down about 7% over the last month. What is behind the sell-off?
Well, there's a number of things, and it really started last Thanksgiving. Gold hit a high of $1,750 right after Thanksgiving holiday, and it's been under pressure since. A lot of big holders of the ETF, which has really gotten hammered over the last 3 or 4 months, have recently said they sold out of their holdings towards the end of the year. But keep in mind that we had the fiscal cliff. We had a number of government political pressures that pressured it at the end of 2012, which I think spilled over into 2013. And let's be honest, clearly the stock market, at least in the United States, has been the investment of choice. And so that safe haven appeal that gold really usually has waned as of late. However, we've seen off the lows from mid-April a significant bounce, technical bounce, but a lot of physical buying, like your previous stories just mentioned, across the world. At the U.S. Mint, we've seen record sales of coins where they actually ran out of the 1-ounce gold bullion coin, and we've seen it in China, Australia, right on down the list. And I expect that to continue. I think these dips, I think people are licking their chops for to come in and purchase the physical, despite what's happening on the ETF side.
Okay, so Sean, I understand ETF, exchange traded fund, for our viewers, that investors are getting more bang for their buck, more return by investing in the stock market, which has been on a tear, at least U.S. markets.
That's right.
But let's focus on the traditional role of gold, and it's traditionally seen as a hedge against inflation. Now, on the one hand, inflation has not been much of a concern because inflation data isn't showing that that's a problem. But on the other hand, we do have central banks around the world just printing money, cutting interest rates, injecting so much stimulus. So wouldn't that cause some concern of currency devaluation and hence a flight to gold?
It has, but it's been on the physical side. That is exacerbated in the last few weeks. You have
when
a
you
battle
say the
going on
physical
here.
side, just explain to our viewers a little bit about what you mean by physical gold as opposed to gold futures.
Exactly, gold futures or ETFs. People wanting to own gold, they see what's going on in the Federal Reserve, printing money, the ECB printing money, Japan printing money. There's no confidence either by central banks or by retailers, individual investors, at least in my view, of currency debasement, as you put it. But there's a crisis of confidence going on here with the fiat currencies of the world. And one way to offset that is by owning gold, taking the physical possession if need be. And that's why we're seeing such strength, at the jewelry shops, at the Federal Reserve for the purchase of coins, and at the Treasury. So,
well, you mentioned the Federal Reserve, and central banks have seen the latest price dip as a big buying opportunity. Why, and why is it so important for central banks to hold gold reserves?
Well, some of them have to, especially in emerging countries, emerging markets. They have to own gold as a percentage of their overall holdings. We're seeing that in Russia, Turkey, some of the former Soviet republics. We're seeing it in other nations too. So they have to hold a certain percentage. And I feel that it's, the Indians, they own, they're said to own 12% of the world's gold. China, which, owns, you mentioned, 5th largest in the world of just over 1,000 metric tons. I think eventually they want to, increase, get the yuan on par with the dollar and the euro. And one way to do that is to hold, gold reserves. They're just not going to tell you when they're going to come in and buy. But you can see at these levels, at new 2.5-year lows, when, we closed 2012 at 1675. This last price dip, we broke down at 1321. That's almost a 20% drop. So traders, investment houses, individual buyers, central banks look at these percentage drops and say, hey, this might be a good time to come in. We might not get this opportunity. I'm not saying that gold's going to shoot right back up higher. We could see some new lows. We could see a retest down there. But nobody's waiting around for it, that's for sure, at least on the physical side is what we've been seeing, especially out of the U.S. Mint.
So long term, you remain a bull. Thank you so much. We're going to have to leave it there. Thanks so much, Sean.